$4 billion ETF, 7-year life track record, 9.3% per annum return. Correlation S&P 500 of minus 0.15, 900 basis points a year of alpha, up 22% in 2022. It's in an ETF with an 85 basis point expense ratio. Is that interesting to you?
Welcome to a new episode of Investology, which is going to be a rare opportunity to discuss CTAs, managed futures, and ETFs with someone with over 30 years of experience in the hedge fund industry, the co-founder of the firm with the longest life track record in the hedge fund replication space, Andrew Beer from DBI.
Historically, a lot of these strategies, many of which have been fantastic for investors, have just been out of the reach of most investors. And I first started thinking about this idea of how do you get some of these strategies into the portfolios of people. If it benefits a big pension plan or a multi-billion-dollar family office, wouldn't it be great if you could also bring some of those benefits to a broader range of investors? And what do we mean by that? We mean basically anybody who is advising clients on their assets, so wealth managers of all different kinds, are basically have a very, very simple goal of trying to help people to grow their assets as much as you can over time with as little risk as you can take to do that. And so if there are strategies out there that can help you to do that, by all means, wouldn't it be great if we could find a way to bring those benefits to millions upon millions, hundreds of millions of people? And so I first started looking at the space in the 2000s. And back in the 2000s, the average hedge fund was much better than the average equity, the average bond. That basically this was had become a cottage industry. It was becoming institutionalized, but it was a strategy that had made a lot of money during the 1990s and didn't go down during the dot-com bust. When everything else got completely crushed, and then comes out of the dot-com crush, and they've discovered the emerging markets trade and the commodity trade, and they're making money again. So if you stood there in 2006 or 2007 and you said, how do I build a portfolio that does that, helps my clients over the next 20 years? And again, the way people do that is they look at decades of data on different asset classes. Hedge funds didn't have that much data, but the data we had was incredible. And so it was such a no-brainer to put hedge funds into a portfolio that was starting with stocks and bonds in the 2000s, and yet the vast majority of it was simply out of the reach of most investors. And so people started to come up with different ways of doing this, and this is where we've been sort of aligned in skepticism. It's just 95% of things just haven't worked, and it gets into kind of the industry structure. People came up with a lot of things that sounded good, but they didn't work once you made them happen. And so what we ended up doing, we ended up focusing on an area called hedge fund replication, which is, again, when you come from the hedge fund industry, it's a lot less mysterious than it is from the outside. And so there are basic truisms about the business. You've got a lot of smart guys. If there's a really great area to invest, commodities in the 2000s or growth stocks in the 2010s, guess what? The smart guys are going to find it. And they're going to find ways of investing in it. So if you could identify what they were doing without having to invest with them, and again, one of the things about hedge funds is it's an extraordinarily expensive way to invest relative to stocks and bonds and most other areas. If you could do that and you could do it cheaply and efficiently, well, then maybe you could really get the benefits and bring it to a broader audience. The irony of what we did is we figured out how to do that for the broad industry, but since the GFC, the hedge fund industry as an asset class has not been a great thing to include to that portfolio. And so I would actually make the argument that if you're thinking about how do you make that portfolio better, you first start with what strategies really add value to it. And so a very, very important shift in our business, as you mentioned, the strategy called managed futures, was 11 or 12 years ago. We said, okay, well, let's take a step back. What's a strategy within the hedge fund world that we think has exactly the specific diversification benefits we want to put in that portfolio? And let's figure out if we can replicate it. And so today we're a bit above 7 billion in AUMs, and it's the vast majority of it is in managed future strategies, because we basically found a way to take what is just, and we could talk about the strategy, just from a statistical perspective, it's a great strategy, and we made it much better. by figuring out how to replicate it cheaply and then take it out to a broader range of investors through vehicles that they could easily invest in.
Right. I've got potentially a lot of questions about what we discussed initially about the sophistication, the democratization, although you didn't use that word. But let's talk about managed future, because that's something that really interests me. And I think perhaps is 7 billion, 8 billion is a big number, but a small number in terms of the global assets there. And I think it's a strategy or an asset class. People are not yet familiar with this, but your efforts. So can we just go through the basics of that? Managed future, what are we talking about?
Sure. So look, it's the worst term to call a strategy managed futures. And look, and most things have names attached to them that sound kind of intrinsically appealing, and managed futures is just hard to tell what it is. It's an interesting. So it's a hedge fund strategy that's been around for 50 years that has consistently been one of the best diversifiers. And the thing is, when we looked at it, there's a way in which people who are practitioners in the business describe it, and they love to talk about complexity. So they'll come in. This would be a typical pitch. If you look at hundreds of futures markets over the past century, AQR writes up stuff like this. There is a persistent statistical phenomenon that if heating oil starts going up over some particular period of time, it is statistically more likely to keep going up. And if wheat is going down over some period of time, it's statistically more likely to keep going down. And when you're getting to the world of quantitative finance, where everything is about statistical probabilities and how to have a little bit of an edge, and this is about value investing and everything else. It's always about not getting NVIDIA right, but getting a lot of things a little bit more right than everybody else. So it's a quantitative based strategy. They're going long and short. They're constantly dynamically adjusting the positions. And when we looked at it, we looked at the space as outsiders, in that I didn't come from the quant side of the business. And it didn't seem that complicated to me. So, okay, so you're doing all these different things, but okay, when something big happens, like you're long oil, you bought gold, and gold went up a lot. When we looked at it, it's like it was always these kind of like big obvious trades, where if it wasn't quantitative, if there was a PM, a great macro manager, they would be telling you about what geniuses they were by being contrarian early and right in some big macro trade before the vast majority of other people saw it. And what the strategy, I think, does, even though it's a very, very complicated strategy in terms of how all of these big funds out there do it, and there are many funds who have built huge businesses around it. I mean, AQR is a huge business doing this. ManHL, Winton, Aspect. I mean, there's a lot of the hedge fund establishment has done things in it. But when we looked at it, we said, actually, what we really like about it is if we can be early contrarian and right in the right trades when the big things in the world are happening, some of the time, doesn't even need to be all the time, you'll get a year like 2022. Inflation is coming back, and yields go up much more than people expect. And commodities go up much more than people expect. And equities and bonds go down more than people expect. And the dollar gets much stronger than people expect. In that year, you have a strategy that was up 20% across the hedge fund space. We're up a bit more because we save money on fees and implementation when everything else was down. Right? That's what you want as a diversifier. Beyond all the statistics and everything else, you want something that's going to help your portfolio when you need it the most. The way we came to the space is basically to say, we're not going to try to do what these guys do with all the complexities and all the costs and everything else associated with it. We're really just going to study what they do. That's what Replication does. Is we're going to go 20, 30 funds out there, that each of which has hundreds of underlying positions, and they're constantly changing it. Well, we're going to look at over some, like today, once a week, and we're going to basically try to figure out what are the big macro themes that you've picked up on, and we're just going to mimic that or replicate it. And what's astonishing about it is that it's so efficient. It is so efficient doing it that way that since we started, we've outperformed virtually every large hedge fund that does this, that have fees, by a lot in many cases. And we
It's a
can
bit
do
like
ETFs.
having
So
a
we have
chef. Sorry, I'm just finding
Yeah.
an image that pops to my mind. I'm gonna replicate the super sophisticated chef's recipe, the free Michelin star, but I'm gonna make it simpler, and it tastes better, or something like that. Which can happen. I feel I used to work with quite a few Michelin star chefs, and sometimes it was very sophisticated, but anyway. But it's just a bit that, and also because it's cheaper. There you go. We don't have to work so hard on this extra performance because it's the fees that don't take it out of the performance.
Yeah, as an investor, I'm happy to pay high fees for things where I can't otherwise access it. There's some incredible opportunity to do it. There are hedge funds out there that have astronomically high fees, and I think they're worth every penny.
Yeah.
You think about a Renaissance Technology, a
There you
D.
go.
Shaw,
If you can get
Citadel.
in,
If you can get in, and Millennium has given their investors a Sharpe ratio of 2.5 over 30 plus years.
Okay.
It's magic, right? But in this space, in particular, I don't think you're compensated for a lot of the costs of it. And so look, we had the advantage of looking at the space in a sense as allocators. And I think it gets back to when you're sitting down with serious hedge fund guys and they're making an investment. The question is usually not whether it's a good idea, whether it's interesting or something, but why? Why is everybody else missing this opportunity? There's a lot of humility at the top echelon of the hedge fund world, because everybody's had great ideas where, hey, there's a 50-50 probability this thing's going to triple and a 50-50 probability it's going to drop in half. And you want to do that all day long if you can do it statistically. And guess what? Half the time it drops in half and you want to shoot yourself. I think in this case, what happens is that the industry has grown up in a particular way. And it's built by engineers who really like the complexity of it. And a lot of their investors have historically liked the complexity of it. You're pitching to people who want to come into the office and hear people tell them about all the statistical nuances of what they're doing, want to engage in almost like sports talk, football talk or something about like the arcana of what this is. And it's interesting and it's fascinating. And you're talking to people with PhDs. It's just not what we were looking for as investors. And so when we looked at the space, we said, all right, if we were to just invest in a pool of hedge funds doing this, we have the access issues with everything else. And guess what? We'd have two phenomenal statistical benefits. We would have zero correlation to both stocks and bonds over 20 plus years. Okay. It's very hard to find. And it's a strategy that structurally seems to do the best when the markets are at their worst. Because that's when things really move outside of the range of expectation. The issue is it's got a Sharpe ratio of 0.3. It earns 250 basis points more than cash over time. Again, which is fine and great if I'm comparing it to bonds, which have underperformed cash over the past 10 years.
Yeah.
But if the strategy is earning hundreds and hundreds of basis points more than that, should I be paying away 2/3 of that or more to get access to the strategy? And so we basically said, look, I think we can get the whole damn thing, but cut out hundreds of basis points of expenses. And so now it's actually creating an interesting dynamic in the industry where, so we have an ETF that we sub-advise in the US. It just broke $4 billion in the strategy. There's only one hedge fund strategy in an ETF that's even been above 2 billion. And so in a sense, this is becoming almost like the beta of the space. And you have to ask yourself, okay, so why, if you're not beating this thing by a lot, if you're not doing something that's wildly differentiated relative to this, why would you bother to go through the brain damage of trying to analyze all these different funds if you could just buy this? So the vision that we had for about 12 years ago was really, I think we can create almost a better version of the space, but almost just become like the easy beta-like allocation. So great strategy, cut out lots of fees and expenses to make it better, bring it to a broader audience. And again, I'm generally not competing with these guys for their institutional clients. Those are the ones who like them and want to keep investing with hedge funds, but rather in the wealth management world, it's shifting from why would I invest with you to why wouldn't I?
No, but I get it. I'm not sure to pitch your business, but you lead it well enough. But I remember my personal limited experience was first from my Kaya diploma. It was a long time ago. And I remember there was this asset class. I mean, they were talking about maybe more what's called CTAs, more than managed future, but we're talking about similar things, right? And that was very much, like you said, decorrelate, performs well in bad times, etc. Ticked all the boxes. Yet, just judging by the amount it took in the curriculum, it was minuscule. People talk about private equity, blah, 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 blah. So the perceived benefits from the research based on the time spent on it was completely different, which I think is also a little bit of a symptom of what's happening here. And I totally get it as well, although I think what's perhaps a little bit complicated in the allocation really is that, okay, equities have performed so well, and therefore that's what you're competing with. But I feel like, or at least in my maybe rational mind, that's what we're competing with. But what I see happening, in fact, is people go into all sorts of different strategies which are perhaps unproven. There's a huge amount of innovation in auto-callables, in strategies within the strategies, etc. And again, 7, 8 billion, what you're doing is amazing. It's a success by any asset manager's size, but there's not that much love for managed future, at least from what I perceive. Perhaps it's starting, And I'm wondering, is there something, is a difficulty in the naming, in the finding, in the understanding, without picking on you, but I see your fund on the Perch fund is called IMGP DBI Managed Future Strategy ETF. Perhaps could there be something there? Or do you think it's just something that's going to take time and love will come in a different kind of circumstances?
Firstly, you're right, in that it is an astonishingly the ratio between diversification benefit and love in this thing is, look, this is a much better diversifier than the vast majority of the hedge fund industry. And people keep throwing their money at things like that just statistically have not been worth it. But look, I think that gets back to a realization that I had about it. Because I used to talk to people about replication. And I would sit in front of an institutional consulting firm. And I would say, look, your clients want lower fee, more liquid solutions for this asset class. I am showing you that I can give you another 100 to 200 basis points of returns. I can do better. I can be a top decile performer over a period of time with a quarter of the fees. And they didn't want to have a second conversation, right? Because people invest in what they like. The people I'm talking to, they went into a job to pick hedge funds. They like their jobs. They don't really want to hear somebody coming along and saying, I think you've been overpaying for the past 10 years. And why are you, because again, it's like private equity, right? It's, as an allocator to private equity, it's the best thing in the world. You go through this kabuki dance of trying to pick which of the private equity firms you're going to invest in. You end up picking one of the top 5 guys anyway. And then you make a commitment to it. There's absolutely nothing you can do for the next 10 years, right? It's just you, and you just wait to see what happens.
But you keep busy with the updates and the...
Of course, the updates. I have to fly to Miami to go to another private equity conference. Whatever. Yeah. So I think there's always this great divide between people who think we should open our investment accounts and start thinking in terms of Sharpe ratios and efficient frontiers and optimization, all sorts of other things. And there are other people who like to gamble. You mentioned kind of auto-callables and buffered ETFs and option income ETFs and all. There are these products right now where basically you get return of principal and get to pretend that it's like you're getting a high coupon on a bond. Again, if you take a step back, and this is always where you get these kind of great like Twitter fights and stuff, is you get diluted equity exposure and you're overpaying for it and you're paying more taxes on it. But I think when you look at the investment world, every investor has a different preference function. Some investors are conservative. Some investors are gunslingers. Some investors are high net worth family, sells their business. And they've had envy of the guy across the street who's got the mansion, who's been invested with high profile hedge funds or whatever. And they're not even thinking about whether it's a good idea to do it today. They want that, right? That goes along with the car and the plane and everything else. So the psychology of investing and what people choose to invest in means that I think at the end of the day, well, at least one of the things I've learned is when I'm talking to people is that if what I'm doing does not is not going to make somebody's life better, make them happier in their office, and make them look better in front of their investing committee or their boss or whatever, they're not going to do it. I can't convince them to do it. And in fact, I'll tell them if I think that their job is different, I'll say, actually, I don't think you should do it with us. You should go pick something else. But what I'm seeing now is, and in part this is because I'm driving it, is there are trillions of dollars of investors who say, my job is to help people retire with more money and sleep at night between now and then. And their portfolios, and they have at least a statistical bone in their body because they care about correlations, expected returns, and other things. Doesn't mean they're going to go very, very far and wide. And I'm starting to chip away and get them to say, look, forget about the bad experience you had on this strategy investing with a fund in the 2010s. Forget about the fact that when people talk about it, it's almost like they're deliberately trying to confuse you and make it impossible for you to then sit and explain it to the people whose money they have. Let's get back to basics and figure out what is the strategy and why is it valuable to you and how do you end up talking to your clients about how it's going to make their lives better. And if I can solve that, then this becomes an asset class. This becomes a strategic allocation. And if it's a 3% allocation across trillions of dollars, when I got into the ETF space, there was 300 million in the strategy. It's 7 billion right now, 7 years later. I am building an asset class here. And I want everybody else to succeed and to grow as well because it's good for investors, whether you pick us or our competitors.
Do you think it just takes a lot of time, etc.? And I'm just not saying that it's not happening. It's already happening, right? You're showing that it's happening, but to open the floodgates completely. Could it be like because we call it a different way?
I think the answer is both. I mean, it requires grueling long-term education. Honestly, one of the issues that I have is not just education, it's re-education. Because if you talk to us, you've probably talked to 6 other people who do this for a living, all of whom are giving you a pitch that basically sounds like, look how many PhDs we have, look how long we've been doing this, look at how many markets we trade, look at how many models we have. That makes us better than the other 5 guys you're about to talk to, and definitely better than Andrew, who you'll probably talk to at the end. And then the next guy says, number 1 was wrong. Actually, he doesn't have enough of these kinds of models or those kinds of instruments. We're adding even more and more things to it, which is why we're better than number 1. And then number 3 comes along and says, number 2's got it wrong. Number 2 is too complicated and too many things. And we've looked at those things we haven't included. So by the time you get to us, people don't know what the hell to think about this space, right? And again, it's different, right? If somebody has said, you have this is your bucket and you have to fill it. At the end of the day, you're like, I really don't know. And you can take Winton and put it next to AQR and maybe add CFM or 1 or 2 others, and you'll have a terrific way, diversified way of getting exposure with unbelievable managers who've been doing this for a long time. That's the institutional playbook. And that's going to continue and will always be, as far as I can, the way that they'll do it, because that's what they want. It's what makes their lives better. You're a wealth manager who's been having these discussions, who your whole life is not trying to figure out this space or the next technical space. And you're thinking about, if I can't make heads or tails of what 1 through 6 just told me, how on earth am I going to explain it to my clients who probably don't know the difference between ETFs and mutual funds? Again, when you mentioned auto-callables, those are great examples of people saying, forget about how the sausage is made. This is the outcome. Option income ETFs. Forget about the prices of the options, the frequency of trading, tax inefficiency, or whatever else that may come along with it. Look at the outcome. Look at what we can give you. And so back to your second part of your question is, if I can get people out of the weeds to the benefits and the outcome. Now, it gets easier for us over time, because even what we describe, right, and in this, we're not going into detail in terms of what we actually do, but if I describe the benefits of what we do, and just give you kind of like, if I say, so we just passed our 7-year track record on this ETF, And the guy that I work with will come in and he'll say, in 45 seconds, you'll tell me whether or not you find this is interesting or not. $4 billion ETF, 7-year life track record, 9.3% per annum return. Correlation S&P 500 minus 0.15. 900 basis points a year of alpha, up 22% 2022. It's in an ETF with an 85 basis point expense ratio. Is that interesting to you? It either is or it isn't, right? So, what we're seeing now is actually most people will say, okay, yeah, okay, at least I want to have a further conversation. So.
That's super interesting. We're going to move on, and I just have a final remark. But I think, yes, to me, this is exactly, it touches me, but I think there's this, perhaps a narrative or something like that, this, whatever, autocall or other fancy things manage to get it, although it's a very complicated stuff that is hard to come through.
It's a very good point. Look, on that, every 6 months, I think I've cracked the code, right? And I think I've come up with the metaphor that gets people to like this. I haven't found it yet. So a lot of people refer to the space as CTAs. Yeah. Okay, so CTAs is an old regulatory term, but it's still a current regulatory term. It technically stands for Commodity Trading Advisor, right? But people still know the name; they know the initials. Like no one can tell you what AQR stands for anymore, right? But it's just AQR. We're DBI. We used to be Dynamic Beta Investments. So there's familiarity with that. But from a marketing perspective, if I say it's contrarian tactical alpha, okay, that now makes sense to people, right? Contrarian I like. Right, tactical, because everything else that I own is not tactical, designed not to be tactical. And alpha, okay, I'm going to lose people who don't have any, but if you're in the fund selection.
We like alpha. No, I think you're cracking it, Andrew, but I want to move on. And just one encouraging remark on that. I used to work in ETFs, right? I was in Phil, was selling ETFs, and that was like over 10 years ago. And we did a little survey in the office on who knows what an ETF is. Obviously, some of us were selling it and structuring it. But we realized that most people in the office, like even the legal people, the majority didn't know. But then a few years later, I was involved with a startup that was called ETF Matic, and my first initial reaction was, guys, ETF, no one cares about ETFs because we did this survey in the office when I was in there. And it turns out that I was completely wrong. It had completely evolved, and the fact that they were called ETFs was driving the flows because people were Googling ETF investing, so it was the right moment. I'm very interested in this, how good solution find the audience, even more.
But can I comment on that? So Thomas Kuhn wrote a book in the 1950s called Structure of Scientific Revolutions. And he talked about how there's an existing paradigm, and everybody's connected to the existing paradigm in their jobs, in what they've been trained, what they learned in school, et cetera, right? And then you start to realize there are problems with the existing paradigm. Things don't work. There are anomalies, et cetera. And they build up, but people still cling to the paradigm. At some point, this is the inflection point that you're talking about, the breaking point, where people all of a sudden realize the new establishment, there's the new paradigm. Mm-hmm. Getting from here to there requires education, re-education, and sometimes it requires a new generation of people. The generation of hedge fund selectors from the 2000s really hated replication because their identities and was about the magic alpha generating properties of hedge funds, and they were it's like Bitcoin zealots. It's like and the ETF it's kind of industry zealots, and so, but a newer generation of people that doesn't have that kind of sycophancy about the industry, they're much more open-minded. They're much more outcome-oriented. So it requires generational shifts. But what's happening on an industry structure perspective, what you need are the big players to start to endorse the space. So I, as a first mover, one of the reasons I wanted to be a first mover in the ETF space is because I knew if I succeeded, I would lure big players into the space as second movers. And so initially, it was some of the big players. ManHL came into the space. Alpha Simplex came into the space. And what do? They're now saying ETFs are okay, right? Before it was never invested in an ETF in the space because it was only WisdomTree and First Trust, and their products were not good. Then it's BlackRock, Invesco, and Fidelity are coming into the space. And so they're sending out armies of people to re-educate people. So you're right. The education goes on. The reason we have model portfolios so much in the U.S. was about firms going out and selling the idea of diversification to hundreds of millions of dollars of end investors and convincing them that this was a proven way with 60-40 portfolios or whatever else to help them to get to their goals and sleep at night. And so I agree with you. I think it's one of the most fascinating things how this changes over time. and how the narrative changes and the language that you use and subtle shifts in the narrative can make a huge difference.
No, it's absolutely, as you said, fascinating, astonishing in terms of the characteristics and the intake. And it's making great progress. But now I want to move on to more technical things because I know the audience are interested in that. The simple question is, how do you work with ETFs? From my understanding, it's ETF providers that use your strategies. Can you talk to us about that?
Sure. So we're a little unusual as a firm in that we are happy and only want to be a sub-advisor to products that other people launch. And we have three principal relationships that we do it with. Now we're 4 and 5 are kind of, but those are our earlier stage relationships. But so in the US, so we have a strategic partner. It was a Paris-based firm called I Am Global Partner. They unlike us, so we're implementation, execution, research. I obviously do talk to people and support them. But they launched the ETF in the US, and we serve as a sub-advisor. We manage the portfolios. But it means they're also responsible for running the fund, marketing, compliance, et cetera, all falls under their bailiwick. We do the same thing for them with Europe, with 2 funds, 2 UCITS funds, which are now both have, actually one started as an ETF, the other one has ETF share classes. And Europe, again, is different where the conjoining of regular mutual funds and UCITS funds is more established practice. In Europe, now they're actually just starting to bolt them together in strange ways. And then we also do the same thing with a U.S. asset manager called SCI, where we've been managing a more diversified UCITS product for them since 2015, and we do the same thing for them in the U.S. The UCITS product is not an ETF, but it may become one over time.
Sure. And so this is about the building up and the architecture of an ETF. And that means that there's a lot of different components coming into play. So what does it mean you do in practice? What do you cover more specifically?
So all of our strategies are entirely quantitatively based. Mm-hmm. And so really what we do is every Monday, we re-examine the data on the managed future space by rerunning statistical models that tell us they're still long crude oil, they're shorting, across the treasury curve. And we do it with a very small group of instruments because we're just trying to figure out the big things that are going to matter over the course of next week. And then, so we do a big rebalancing across our portfolios on Monday, and then if Tuesday money comes into one of our funds, then we do small rebalancings, and then Wednesday money comes into one of our funds, we do small rebalancing. And the trading that we do, we only invest in futures contracts, and it's about 15 futures contracts or so across our business. It's highly, highly, highly automated. And we're also very unusual in that the strategies, the models that we employ, our goal is to not have to change them under the theory that a really great investment idea is something that you decide to do today that's still working in 10 years or still working in 20 years. We spend a lot of time looking at what we're doing and evaluating. We conduct a lot of research on it, but it's basically, we think we have figured out certain approaches that in very, very narrow areas, we figured out ways of making this work and where we can beat hedge funds through accuracy and efficiency. And back to your point about narrative shifts, we are far simpler than anybody else out there. Like you look at our ETF in the US or the ETFs in Europe, and you'll see 10 futures contracts and short-term treasuries. You will look at a mutual fund competitor of ours, they might have 10 to 20 pages of positions in their annual filings. That was a highly, highly, highly contrarian and unpopular view on how to get exposure to a hedge fund strategy 12 or 15 years ago. There are a lot of people who have been burned so many times with complicated things that haven't worked well that now sometimes with the right audience, you'll see a great deal of relief at the simplicity and efficiency of it.
And how portable is that? So let's say you mentioned what those ETF, I'll call them ETF providers, do. Let's say I've got an ETF company. I feel like I'm great at marketing and packaging and the legal stuff that you don't do. I want to have the DBI strategy or one of them. So would you be able to create something tailor-made? Would you onboard something else? And is there something in terms of my infrastructure that I need to have on board in order to be able to take it on?
We're loyal and committed to the partners that we worked with for a long time.
Sure.
So we don't.
I guess yes. Maybe there's an exclusivity agreement, but let's just. I'm more interested in the theoretical aspect of the infrastructure and what it takes to set it up. I'm not about to launch my own.
Within the context of our business, I do more of this stuff. So I try to remain as blissfully unaware of the nuances of exactly how the plumbing works. But we trade daily liquid, exchange traded futures contracts, and manage portfolios of treasuries or the equivalents. It's not complicated operationally. Where there's a new part of our business. So one of the things we have these two different strategies, right? Why don't we have 10? Because my job is only to launch a product where I am 80% confident that I can beat the hedge funds that we're being referenced to and make it work really well in a liquid vehicle. And short answer is that only works. You cannot do that with large parts of the industry. So we focus on where we can. One of the problems that the broader space has had is people have tried to do things like this or lots of other things with areas where they shouldn't. And you have a spicy term about the proliferation of products. But basically a lot of distribution in this business is built about shooting as much at the wall and hoping you have something that's done well over the past 6 months or year or 2 years, and then unleashing your marketing horde, your distribution horde after, which I think is terrible for investors, and it makes it very, very confusing because you get bombarded with calls and information about stuff that really was not built to help you make money from an investment perspective, built to extract as much fees from you as it can in a short enough period of time before you realize that it's a mistake or in the time it takes to get out. But an area where we have gone is we did a partnership with an investment bank, SocGen, in 2024, where they have actually created an index around one of our core strategies. And so there are asset managers who basically said, hey, I really like what DBI does, but I can just go directly to SocGen and get exposure to it, and I'll just talk to them about getting exposure via swap. DBI is somewhere in the background as a model provider on it. And in disclosure, we get compensated if somebody ends up using it.
Sure.
But that's sort of the direction. And actually, the two asset managers who are taking that and building, as you say, in your case, it would be and building products around it. Simplify, rapidly growing ETF firm in the US, launched something earlier this year, and then in the UK, a firm called Fortum is doing the same thing, hopefully later this month.
Okay, so let's give us a little different paths to market, either direct partnerships or through the index, and then there's this indexing, etc. Because like S&P, who comprise the methodology and in the index, there's a different step there. But okay, that's really interesting. And then maybe to finish off, we've discussed this quite a bit, right? In coming of new products, etc. The innovation in asset management broadly. But how do you see the outlook, and in particular, in terms of this innovation in products?
I think this goes back to I mentioned about the heterogeneity of investors, right? And so you've got, I don't know what the pool of investable capital is it's 100 trillion or something insane, right? It's just, the numbers are just mind-boggling. But within that, you might have 10,000 submarkets, and divided by geography, whatever. Along all sorts of different criteria. And at the same time, because of technology and everything else, the cost of creating new products, ETFs, et cetera, has come way down, right? It was a big deal to launch an ETF. Now you have turnkey platforms where you can kind of do it overnight. And also a lot of marketing and distribution has become much more efficient. So you don't need to hire 52 people to go out with pitch books, to drive around in their cars with pitch books, to walk into the office of everybody in Des Moines, Iowa or something. You can do podcasts like this, and you can kind of get the message out and let people end up finding you if what you're doing happens to meet their preference function. So, but I think the same thing is true with Bitcoin and crypto, and investing is, a lot of asset allocation is theater. A lot of wealth management is theater around the human dynamic of trying to help people to feel comfortable. Money is so anxiety provoking. If I don't have enough, I don't retire. If I do worse than that annoying guy across the street, because he's in SpaceX and I'm not, even though so the wealth management business, the asset management business is so much about just the structure of the principal agent issues, who's got what job and why they have it, and what allocators are looking for and what makes them happier. And I gave this talk in London about one of our strategies, And I had 12 slides showing the diversification benefits. It was in a room of maybe 200 wealth managers. And my 13th slide was, and none of your clients will give a shit. And they're like, and they're surprised. I said, because in the wealth management space, no one's going to wait around 20 years to see if you raise their Sharpe ratio by 0.05. If you're in 2022 and we're up 22% and everything else is down, okay, like that's going to matter to you. If the next year we're down 8 and everything else is up, okay, you got to talk about how you're going to manage that. So you're there then in 2024, 2025, and 26 when we're doing really well again. And people, it's their right to do dumb things with their money from a long-term investment perspective. It's their right to gamble. It's their right to, you have a ton of money and you go to a Swiss private bank that puts you into tons and tons and tons of really, really expensive things, and maybe there's some sort of a pay-to-play involved in it or whatever. It's your choice. And you're going to them for something. And trust me, it's not about long-term Sharpe ratio maximization. You want to maximize your long-term Sharpe ratio? Yes, put it into those 3 basis point products and have the most boring, efficient portfolio and forget about diversifying outside of equities, right? Warren Buffett sometimes really nails it. And they said, if you didn't have Berkshire Hathaway, what would you do? I said to put 95% of my money into the S&P 500 in the cheapest, most tax-efficient product possible, and I put 5% in cash in case I need it. And that's it. And not look at it and go do something else, go fish or something. And so all of this stuff, all the product development and the motivations of people who are on the sales side to get somebody to buy something today so they can get paid today, they're not worried about what it's going to look like in 5 or 10 years. From my perspective, as a guy building a business, where we are today, I hope this is just the beginning, because it took me forever to kind of hit one of those inflection points, and now we're growing fast. But if I do a bad product, that could be 30% of my time 5 years from now. And I don't have another 30% of my time. If we do something unethical, it's a huge distraction in our business. So my thing has been basically like, I'm only going to launch products that I believe will work. Mm-hmm. And I will tell you exactly what my investment function is and what I'm trying to solve. In our products, we're trying to basically show that we can get you the diversification benefits of these 2 particular hedge fund strategies. We can do better over time and with lower fees and liquidity and hopefully less downside risk. Right? But I'm only going to launch a product if I can do that. And that also, by the way, is part of why it makes sense to be a sub-advisor, not a manager. Because our partners may have lots of different products that they can focus on. So in every product, we'll go through better and worse periods. But I don't want to create 6 more products just so I make sure my big marketing and distribution team has something to do every day. I'm going to focus on building the best products I can and let my track record season and repeat the messages to it's not working by accident. It's working because the design and the investment thesis are right. And we'll put into client-friendly vehicles. And yes, there is all this other stuff going out there, but one of our clients, who's probably the most reputable bank in the world, says there is no firm out there on the alt side that they think has better value for money than us in terms of what we ask to get paid, given the amount of alpha outperformance, or whatever that we end up generating for people. But if we can continue to deliver that in the right kinds of vehicle, then over time, if you look at the managed futures ETF space, there are other great products out there. But we're definitely 60% of the space, maybe, or something. Mm-hmm. Because there's something in that pitch. There's something in the longevity which we're doing that's resonating with people. And knock on wood, we think it's gonna continue.
No, absolutely. I would have a philosophical and business question, all that, but we're running out of time, Andrew. So I really want to thank you. And I think, yes, indeed, my question has always been like, definitely not about your success, which is tremendous, but more about how come is it not even bigger? But we discussed it thoroughly. I also wanted to do a couple of shout outs of people that I was planning to mention and previous guests, such as Phil Beck and Nicholas Schrader, but I'll put the links because those conversations are related. And we also put a lot of links, including, what was some very interesting statement you mentioned about the performance, etc., in the show note. But also, what's the best way to, reach out to you and keep in touch and follow your work?
I'm on LinkedIn. We also have a website, dbi.co. The running joke is we're so efficient, we didn't need the N. We have stuff there, and obviously if you're on the product side, it connects you to all of the partners we work with. But I'm really accessible on LinkedIn. A really smart guy who's not in our industry reached out to me recently over LinkedIn, and we're having really interesting conversations. He's brought really interesting ideas in terms of a part of this business that he knows that we don't know. Don't hesitate to reach out. And
amazing. Andrew, thank you so much for your time, and we'd love to hear, any comments, thoughts, questions, etc. from people, so don't hesitate to comment. Until next time, all the best.
thank you, George.